There are almost $3 trillion sitting inside a slow-motion disaster that most Americans have never heard of. It is not buried in a trading algorithm. It is not hidden inside a cryptocurrency exchange. You can see it from the highway. You have driven past it on your way to work. It is sitting in plain sight on the skyline of nearly every major city in the United States. Dark windows, empty corridors, half-empty parking structures attached to office buildings that were once the most valuable commercial real estate on Earth. And right now, the loans that were used to build and maintain those buildings are coming due, all at once, at interest rates nobody planned for. Experts are calling it the maturity wall, a concentrated wave of commercial real estate debt over $1 trillion due in 2025 alone, nearly triple the 20-year historical average, is crashing into a lending environment that has fundamentally changed. Properties that were financed at 3% interest are now being forced to refinance at 7 or 8%. Buildings whose valuations have dropped by 30, 40, sometimes 70% since the pandemic are being asked to carry the same debt load they carried when the world still commuted to an office 5 days a week. The math does not work, and the people who hold that debt, banks, pension funds, insurance companies, ordinary Americans with retirement accounts, are quietly absorbing the damage. This is the story of how it happened, how serious it has become, and why the people managing this crisis may be making it worse. To understand what is happening to commercial real estate, you have to understand what commercial real estate actually is. Most people think of real estate as houses, but commercial real estate is an entirely separate universe. The office towers, shopping malls, hotel chains, apartment complexes, industrial warehouses, and retail strips that make up the physical backbone of the American economy. And like any asset class in modern finance, commercial real estate does not run primarily on equity. It runs on debt. The model is straightforward. A developer or property owner takes out a loan, typically a commercial mortgage, to purchase or develop a property. The loan is secured by the property itself. The owner generates revenue from tenants, uses that revenue to service the debt, and eventually refinances or sells. As long as the building stays occupied and interest rates stay manageable, the system works. For decades, it worked extraordinarily well. The years following the financial crisis of 2008 ushered in an era of historically low interest rates. The Federal Reserve kept rates near zero for years and then years more. Borrowing was cheap. Commercial real estate values climbed steadily. Office space was in perpetual demand. Major corporations signed multi-decade leases on millions of square feet in cities like New York, San Francisco, Chicago, and Los Angeles. Developers built to meet that demand. And then everything that underpinned the model was dismantled in a single season. In March 2020, the pandemic shut down the American economy. Offices emptied overnight. Tens of millions of white-collar workers began doing their jobs from kitchen tables and spare bedrooms. For months, city centers that had been the most valuable commercial real estate on the planet sat completely empty. The question everyone asked in 2020 was whether workers would come back. By 2022, the answer was becoming clear. Many of them would not. At least not every day. Not in the numbers that commercial real estate had been built to absorb. Remote work had permanently restructured the demand for office space. Companies discovered that they did not need 50,000 square feet, when 12,000 square feet and a flexible work-from-home policy produced the same output. Lease renewals were declined. Major corporations began downsizing their physical footprints aggressively. The sublease market, office space that tenants were actively trying to get out of, flooded with inventory. By 2024, office vacancy rates in San Francisco had climbed above 35%, levels the city had not seen since the dot-com collapse of the early 2000s. In New York, a city that had long defined itself by its skyline, vacancy in the central business district was approaching historic highs. In downtown Chicago, in Houston, in Washington, entire city blocks of premium commercial real estate were sitting largely empty. The value of those buildings was in freefall, and the loans attached to them were still on the books. This is where the story becomes a financial crisis rather than simply a real estate story, because the loans attached to commercial real estate do not behave like residential mortgages. They are structured differently. They are typically shorter term, 5 to 10 years. They come with balloon payments due at maturity. And in the years between 2015 and 2022, an enormous volume of that debt was originated during the era of cheap money. According to data from the research firm TREP, $1.2 trillion in commercial real estate loans matured in 2024 and 2025 combined. Another $1.8 trillion is scheduled to mature between 2026 and 2028. That is $3 trillion of loans that were written at one set of financial conditions: low rates, high valuations, strong occupancy, that now must be dealt with in a completely different world. When a commercial real estate loan matures, the borrower has three options. They can pay it off in full, they can refinance it, or they can default. Paying it off in full is rarely possible. These are multi-hundred million dollar loans attached to multi-hundred million dollar properties. So the realistic choice is refinancing or default. And refinancing has become, in many cases, functionally impossible. Here is why. A building that was valued at $100 million in 2019 and financed with a $70 million loan at 3.5% interest might now be worth $60 million. The loan that once represented 70% of the building's value now exceeds 100% of its value. The property is underwater. No rational lender will refinance a loan that is larger than the asset backing it. And even if a lender could be found, servicing that same debt at 7 or 8% interest on a building that is 30% vacant generates losses, not income. The only exit in those scenarios is a distressed sale, a restructuring, or a default. We have already seen what default looks like at scale. In 2023, Brookfield Asset Management, one of the largest real estate investment firms on the planet, defaulted on over $1 billion in loans tied to two iconic office towers in Los Angeles. The company, which managed hundreds of billions in assets globally, made a calculated decision that it was financially better to hand the buildings back to lenders than to continue servicing debt on properties that were no longer worth what they owed. That same year, Pacific Investment Management Company, known globally as PIMCO, defaulted on $750 million in loans tied to a portfolio of office properties across the United States and Europe. These were not small operators making reckless bets. These were the largest, most sophisticated real estate investors in the world. And they walked away. WeWork, the office sharing company that had once been valued at $47 billion, declared bankruptcy in November 2023. Its collapse did not just wipe out its own investors, it flooded the sublease market in cities across the country with millions of additional square feet of office space that no one needed, further suppressing values and occupancy for every building around it. Now is a good time to pause and ask the question this channel exists to answer. Because this story is not just about empty buildings. It is about what happens to the system that is holding the debt attached to those buildings. If this is the kind of story you believe deserves a wider audience, the real mechanics of how financial systems crack, told without the noise, subscribe to WreckLedger and hit the notification bell. Every empire leaves a ledger, and we read every one of them. When we talk about who holds commercial real estate debt in the United States, the most important word is banks. And within that word, the most vulnerable institutions are not the largest ones. The major American banks, JP Morgan Chase, Bank of America, and Wells Fargo, have enormous balance sheets and significant capital reserves. They are not immune to commercial real estate losses, but they are large enough to absorb them without threatening their own survival. The institutions that are most exposed are the small and mid-sized regional banks, the community banks, the lenders that were built to serve local economies and that poured significant portions of their loan books into local commercial real estate during the decade of cheap money. According to a report from the United States Government Accountability Office, as of 2023, commercial real estate loans represented more than 300% of total capital at more than 700 American banks. That means that if those loans began failing in significant numbers, those banks would have no buffer left. They would face the same existential math that consumed Silicon Valley Bank. Losses large enough to threaten the institution itself. The Federal Reserve had been watching all of this accumulate. In 2023, it identified commercial real estate as one of the primary financial vulnerabilities in the American banking system. Multiple stress tests flagged the concentration of commercial real estate exposure at regional banks as a significant systemic risk. Regulators began pressuring banks to build capital cushions specifically in anticipation of commercial real estate losses. But banks had a tool that regulators found difficult to address directly. A practice that the financial industry had quietly normalized, a practice that the people inside the industry called with a kind of dark honesty, extend and pretend. When a commercial real estate loan matures and the borrower cannot refinance it at acceptable terms, the lender has a choice. It can declare the loan in default, force a distressed sale, and absorb the loss immediately. Or it can modify the loan, extend the maturity date, adjust the terms, and avoid recognizing the loss on its books for another year or two. Extend and pretend. Banks chose to extend and pretend at extraordinary scale. Instead of forcing a reckoning in 2023 or 2024, lenders pushed the maturity dates forward, hoping that interest rates would fall, that occupancy would recover, that valuations would stabilize enough to make the math workable again. The losses were not recognized, they were deferred. Deferred losses are not resolved losses. They are just losses that have not yet appeared on the official ledger. By early 2025, nearly $1 trillion in commercial real estate loans scheduled to mature that year represented, in the words of one financial analysis, nearly triple the 20-year historical average. And the interest rate environment that banks had been hoping would improve had not improved fast enough. The Federal Reserve had cut rates from their peak, but not to the levels necessary to make the most distressed properties viable again. The extend and pretend runway was running out. The consequences of what comes next are not confined to banks and real estate developers. American pension funds, the retirement savings of teachers, firefighters, police officers, and public employees across the country have significant allocations to commercial real estate as an asset class. When commercial real estate values fall, pension fund portfolios fall with them. The retirement security of millions of Americans who have never signed a commercial lease in their lives is directly connected to what happens in those empty office corridors. Life insurance companies hold commercial mortgage-backed securities, complex financial instruments built from pools of commercial real estate loans, as long-term assets backing their policyholder obligations. As those securities deteriorate in value, insurance company balance sheets deteriorate with them. Even local governments are exposed in ways that are rarely discussed. Commercial real estate is one of the primary drivers of property tax revenue in American cities. When office building valuations collapse, the tax base of the cities that depend on that revenue collapses alongside it. San Francisco, already facing a fiscal crisis driven by office vacancies, was projecting hundreds of millions of dollars in property tax revenue shortfalls as building assessments were revised downward. New York City faced similar calculations. The social services, infrastructure, and public systems funded by those revenues all face the same pressure. What does it cost to leave an office building empty for years? More than most people understand, it costs the workers who no longer commute to the restaurants, coffee shops, dry cleaners, and retail businesses that built themselves around that foot traffic. Those businesses close. Those employees lose work. The neighborhoods that were built around the daily rhythms of office life hollow out. This is not simply a story about investment losses. It is a story about how a financial structure built on a set of assumptions, namely that interest rates would stay low, that workers would commute, and that cities would remain the gravitational center of economic life, was exposed when every one of those assumptions was invalidated simultaneously. By the spring of 2026, the commercial real estate debt crisis had not yet produced the single catastrophic collapse that would define it in the history books, the way Lehman Brothers defined 2008. What it had produced instead was something arguably harder to manage, a slow, grinding, distributed deterioration spreading across thousands of properties, hundreds of lenders, and dozens of cities, at a pace that made it easy to look away. Regulators continued to stress test banks. Banks continued to extend and pretend. Properties continued to sit empty. The maturity wall continued to cast its shadow forward. The Federal Reserve's own financial stability reports had warned, with unusual directness, that commercial real estate represented one of the clearest near-term threats to the stability of the American financial system. Not a theoretical risk. A present one. There is a line that appears in the financial statements of every institution exposed to commercial real estate debt. It describes the gap between what a loan is worth on paper and what it would be worth if it had to be sold in the market today. Accountants call it an unrealized loss. Everybody else calls it a problem that has not yet been paid for. The American commercial real estate market is sitting on hundreds of billions of dollars in unrealized losses. They have been deferred, extended, restructured, and reclassified, but they have not been resolved. History is very clear about what happens to unrealized losses that are never resolved. They do not disappear. They do not improve with time. They compound. And eventually, one way or another, someone pays them. The buildings are still standing, the loans are still due, and the ledger is still open. Every empire leaves one. If this story made you see the financial system differently, share it with someone who thinks the real estate market is someone else's problem. Because the next entry in this ledger has already been written, it just has not been delivered